All right, Addy John here, and I need you fully locked in for the next few minutes. What I'm about to walk you through is not speculation, it's not theory, and it's not financial doom content designed for clicks. On January 27, 2026, the National Association of Insurance Commissioners released new data showing that insurance insolvencies surged 43% in the fourth quarter of 2025 compared to the same period in 2024. That same week, 3 regional property and casualty insurance companies operating in Florida and California were placed into receivership, impacting more than 870,000 policyholders. This is not a market crash. This is not panic. This is not a prediction about something that might happen. This is what happens when an entire industry, built on actuarial assumptions from a different era, collides with climate volatility it never priced, investment portfolios it can no longer support, and a regulatory framework that is already at least 18 months behind reality. Your insurance policy, the contract you've been paying premiums on for years, is not the guarantee you believe it is. It is a conditional promise, backed by reserves that are shrinking, investments that are underwater, and a state guarantee fund system that was never designed to absorb simultaneous failures across multiple states. The question is not if this is happening. The real question is how much time you have before your policy becomes a claim against an insolvent institution. I've watched insurance crises unfold before. The mechanics never change. The company names change. The trigger events change. But the underlying sequence, reserve depletion, investment losses, and regulatory intervention, follows the same pattern every single time. And right now, we are in the early acceleration phase, where pressure is building faster than the system can adapt. In this video, I'm going to break down exactly what is happening inside the insurance industry, why the collapse mechanism is already in motion, and, most importantly, what you need to do in the next 30 days to avoid holding worthless paper when carriers start failing in clusters. By the end of this breakdown, you'll understand the structural flaws that make this outcome unavoidable, and you'll walk away with a clear, actionable framework. So stay with me, because the preparation window is shrinking every single week. Let's start with the core framework you must understand, because without it, this crisis looks random. It isn't. It's systematic, and it's been building since 2018. Insurance companies operate using what's called the combined ratio. This ratio measures claims paid plus operating expenses divided by premiums collected. If the combined ratio is below 100%, the insurer is profitable on underwriting. If it's above 100%, the insurer is losing money on every policy it writes. For more than a decade, the majority of property and casualty insurers in the United States have been operating with combined ratios above 100%. They've been losing money on underwriting. So how did they stay solvent? Investment income. Insurance companies take your premium dollars and invest them, primarily in bonds, before they have to pay claims. Historically, the returns from these bond portfolios covered underwriting losses and still produced profits. But here's where the system broke. When interest rates sat near zero for more than a decade, insurers were forced into long-duration bonds just to generate any yield at all. They loaded up on 10-year, 20-year, and 30-year treasuries and corporate bonds yielding 2% to 4%. Then came 2022 and 2023. The Federal Reserve aggressively raised interest rates and bond prices collapsed. A bond paying 2% that was issued in 2020 is now worth 60 to 70 cents on the dollar because new bonds are paying 5% or more. As a result, insurers are sitting on hundreds of billions of dollars in unrealized investment losses. At the exact same time, claims are accelerating. In 2024, hurricane losses exceeded $120 billion, the second highest total on record. Wildfire losses in California reached $38 billion. Hailstorms, floods, and severe convective weather events are increasing in both frequency and severity. The actuarial models insurers used to price policies 5 years ago were based on historical loss patterns. Those patterns no longer apply. Insurers are now paying claims 30% to 50% higher than their models anticipated, and they can't raise premiums fast enough to close the gap because state regulators' cap rate increases. This is the squeeze. Rising claims, collapsing investment portfolios, regulatory limits on pricing. By the third quarter of 2025, the combined ratio for the property and casualty industry reached 108.3%. That means for every dollar collected in premiums, insurers were paying out 1.08 in claims and expenses. They are bleeding capital. The only thing keeping many of them alive is the hope that investment returns will rebound. But investment returns are not improving. They're deteriorating. And the capital buffer insurers rely on is shrinking quarter after quarter. Now let me explain the mechanism that turns this from a problem into a systemic crisis. Insurance is built on pooled risk. When you buy a homeowner's policy, your premium enters a pool with thousands of other policyholders. Actuarial science estimates how many claims will occur and prices the pool accordingly. This model works when losses are statistically predictable and geographically diversified. But that's not what's happening now. What we're seeing is correlation. Hurricanes are wiping out entire regions at once. Wildfires are destroying thousands of homes simultaneously. Hailstorms are totaling tens of thousands of vehicles in a single event. The geographic diversification insurers depended on is breaking down because climate-driven events are producing synchronized losses across entire books of business. When losses are correlated, the pool doesn't just pay out more, it pays out all at once. That creates a liquidity crisis. To pay claims, insurers are forced to liquidate investments. When they sell bonds in a down market, they realize losses. Realized losses reduce statutory capital. When capital falls below regulatory minimums, state insurance commissioners step in and place the company into receivership. This is not theoretical. In December 2025, Lighthouse Property Insurance, based in Florida, was placed into receivership after its surplus dropped below required levels. Policyholders were shifted to the State Guarantee Fund, already underfunded by an estimated $4.2 billion. In California, 3 smaller wildfire-exposed carriers were declared insolvent in the first quarter of 2026. Their policies are now being administered by the California Insurance Guarantee Association, which caps claims at $500,000 per covered loss. If your home is insured for $1.2 million and your carrier fails, you receive $500,000. The remainder becomes an unsecured claim in a bankruptcy process that could take years. And here's what almost nobody understands. State guarantee funds are not pre-funded insurance pools. They are assessment-based systems. When an insurer collapses, the guarantee fund charges remaining solvent insurers to cover the losses. Those insurers are allowed to pass those assessments on to policyholders through premium surcharges. So not only do you lose coverage, you also pay higher premiums to rescue failed companies. This creates a doom loop. Failures trigger assessments. Assessments raise costs. Higher costs weaken surviving insurers. Weaker insurers fail, and the cycle accelerates. We are now in the early stages of that loop, and its speed is increasing. Now let me give you the historical context, because this exact scenario has played out before, and the warning signs today are identical. In the mid-1980s, the insurance industry was hit by a crisis driven by asbestos exposure and environmental liability claims that insurers had never priced into their policies. Between 1984 and 1986, more than 60 property and casualty insurers collapsed. State guarantee funds were overwhelmed. Policyholders across multiple states faced massive coverage gaps, and for those who could even find replacement coverage, premiums surged 300% to 500%. That crisis forced a fundamental restructuring of the insurance industry and led to the creation of residual market mechanisms, government-backed insurers of last resort. Those mechanisms still exist today. In Florida, it's called Citizens Property Insurance Corporation. In California, it's the FAIR Plan. These programs were meant to be temporary safety nets for properties that private insurers wouldn't cover. Instead, they've grown into massive risk concentrations. Citizens Property Insurance now covers over 1.3 million policies in Florida, with total exposure exceeding $600 billion. California's FAIR Plan has grown more than 150% since 2020. These entities are not capitalized like private insurers. They're funded through assessment authority, meaning if catastrophic losses occur, every policyholder in the state pays, whether they use the plan or not. This brings us to the second historical parallel, the savings and loan crisis of the late 1980s and early 1990s. More than 1,000 thrift institutions failed because they were trapped holding long-duration, low-rate mortgages while interest rates surged. The mismatch between assets and liabilities wiped out the industry. The federal government was forced to step in with a taxpayer-funded bailout costing $132 billion. The insurance industry is facing the same imbalance today. Long duration, low-yield bonds on the asset side, rising claims and operating costs on the liability side. And just like the S&L crisis, the breaking point arrives when capital reserves are exhausted and there's no private market solution left. The critical difference? Insurance protection is state-based, not federal. There is no FDIC equivalent. There is no unlimited federal backstop. When failures accelerate, states will run out of capacity, and policyholders will be left exposed. Now let's connect this to the broader macro environment, because the insurance crisis is not occurring in isolation. It's unfolding at the same moment the global financial system is under maximum strain. Global debt is at record levels. Interest rates have risen sharply. Commercial real estate is in distress. Regional banks are sitting on massive unrealized losses. Consumer balance sheets are stretched thin. Insurance companies are financial institutions. They hold enormous bond portfolios. They invest in commercial real estate. They rely on functioning credit markets. When credit tightens, when bond values fall, and when real estate freezes, insurers are hit from every direction simultaneously. We saw this in 2008. AIG, one of the largest insurers on the planet, collapsed and required a $182 billion government bailout. The trigger wasn't traditional insurance losses, it was investment and derivatives exposure that erased capital. The lesson from 2008 is simple. Insurance companies are systemically interconnected. When financial stress rises, insurers amplify it because they operate with leverage, long-tail liabilities, and mark-to-market portfolios. Right now, financial stress is rising. Credit spreads are widening. Bankruptcies are increasing. Commercial real estate values are falling. Reinsurance costs are exploding. Insurers are positioned on the wrong side of all of it. Their bond portfolios are underwater. Their real estate investments are losing value. Reinsurers are pulling back from climate-exposed risks. This is a multi-front crisis, and it's accelerating. Let me walk you through the 3 pressure points that will drive the next wave of insolvencies. Pressure point 1. Reinsurance capacity. Reinsurance is insurance for insurance companies. Primary insurers transfer portions of their risk to reinsurers to survive catastrophic losses. Reinsurance contracts are renewed annually during January renewal season. In January 2026, property catastrophe reinsurance prices rose an average of 35% year over year. In Florida and California, increases exceeded 60%. Some reinsurers are refusing to offer new coverage entirely in high-risk regions. That leaves primary insurers with 2 options, both disastrous. Pay dramatically higher reinsurance costs and destroy profitability, or retain more risk internally and gamble on survival. Neither option is sustainable. Pressure point 2. Regulatory intervention that backfires. State insurance commissioners are under political pressure to keep premiums affordable. In response, they delay or deny necessary rate increases. In California, homeowners' insurance rate hikes above 7% haven't been approved since 2022, despite insurers requesting 30% to 50% increases. This creates adverse selection. The strongest insurers exit the market. Weaker insurers remain. Failures increase. Risk concentrates further. Regulatory intervention accelerates collapse. It doesn't prevent it. Pressure point 3. The investment portfolio. Time bomb insurers are legally required to hold mostly investment-grade bonds, but bonds have not been safe. In 2022, the Bloomberg Aggregate Bond Index fell over 13%, the worst bond market year in modern history. Insurers that loaded up on long-duration bonds between 2019 and 2021 are still sitting on deep unrealized losses. Statutory accounting allows them to carry bonds at amortized cost until they're forced to sell. When claims spike, they must sell. When they sell, losses are realized. Capital collapses. Receivership follows. This is the exact mechanism that destroyed Silicon Valley Bank in March 2023. Insurance companies face the same risk, except the trigger isn't deposits, it's claims, and claims are accelerating now. So what are the 3 asymmetric plays in this environment? First, self-insurance through liquidity. You must reduce dependence on insurance payouts. This means holding significantly more liquid capital, enough to withstand major losses while claims are delayed or denied. Second, geographic and counterparty diversification. Do not concentrate insurable assets in high-risk states or with single carriers. Spread exposure, use multiple insurers, separate ownership through legal entities. Third, hard asset allocation. Outside the insurance system. Physical gold and silver carry no counterparty risk. They can't default, they can't be frozen, they can't be diluted. In a system losing trust, hard assets become the settlement layer. Now here's your immediate action checklist. 1. Verify your insurer's financial strength rating today. Anything below A- increases counterparty risk. 2. Understand your state guarantee fund limits. Most cap coverage at $300,000, $500,000. 3. Increase emergency liquidity. Claims in receivership can take 18 to 24 months. 4. Prepare for 50%, 100% premium increases over the next 3 years. 5. Explore alternative risk transfer tools, captives, parametric insurance, and risk retention groups. The insurance industry will not warn you. Carriers will keep collecting premiums right up until receivership. Regulators will publish lagging data. Mainstream media will downplay systemic risk. By the time the crisis is obvious, the window to act will be gone. So here's the question I want you to answer in the comments. Do you know your insurer's financial strength rating? And if they failed tomorrow, do you have the liquidity to survive the delay? If this breakdown gave you clarity, subscribe and turn on notifications. This channel exists to expose structural risks early, before optionality disappears. Share this with anyone who owns property, runs a business, or depends on insurance. The crisis isn't coming. It's already here. Take action. Stay informed.